Yeah. There's close to 3 million tokens in circulation. Um, and those are tokens with $0 in market cap, meaning they were scams, got drained, and they just still exist. Or, a $1 trillion token like Bitcoin. And I would say of those 3 million tokens, maybe 50, 50 are competing to be a currency. Um, if that. The rest of the market, 99.9% of the market, is using blockchain technology for a myriad of things, and trying to change a lot about how the internet works. So whenever I hear someone think of this industry as a currency market, similar to like Forex as an example, it's borderline offensive to the technology, really. But I understand. Mainstream media has led everyone to believe that it's a scam, it's for money launderers, criminals.
And welcome back to the Money, the Mindset, and the Mentoring podcast. Today, we are here with Jay Tullis. He runs a crypto hedge fund. Yes, that's right. You heard me. A crypto hedge fund. And so it's called Bleeding Edge Capital. And so when I first started talking with you, I was like, what are the big buzzwords of 2024? Let's just hit them. Number one, AI. Everybody talks about AI. That is the thing everybody's hitting. The next one people talk about is podcasts. It was exactly what we're doing. Podcast. And the next big buzzword is crypto. Now, when you and I were talking, we had a massively different opinion on how crypto works, in the sense that I don't know that much about it. I'm going to be very honest. But when I hear people talk about it, a lot of them they talk about is things like Bitcoin or Ethereum, and how it's used as it's going to be the next big thing in currency. And you sort of went, stop the presses. Let's talk about it more like steel. So when we were, and that just blew my mind. And then we went through a preamble on that. And I'm so excited to share your perspective of looking at crypto, not as this up and down volatile currency, but as the baseline building blocks that are being used in the internet today.
Wonderful way to put it. I would agree. Yeah. They really are. I don't want to say I want to say this whole industry is an evolution of the internet. And when you start understanding the assets as you said, raw material to build upon, the industry and the markets get a lot more clear from a fundamentals perspective. I'm not a trader, I'm an investor. I think there's a very important distinction there.
Well, let's hit that distinction. The distinction between, you just said something, and you're in the Bitcoin space. So what you just said is really antithesis to what we hear everywhere else. You said, I'm not a trader, I'm an investor. And let's really delineate that, because I think that's extremely important.
I think, yeah, it really goes back to some of my mentors. And, the nice thing is it's all free and public. Ray Dalio, Warren Buffett, Franklin Templeton, his book. Benjamin Graham. I like buying really good things at a very good price, and then I hold on until But see, the thing is, you got to know what really good things are. The line that resounds in my mind is, most people don't get rich because they don't want to do it slowly. And 99% of Warren Buffett's wealth happened after age 53. So it's having a very long-term perspective, patience, calmness, and being able to ride the storm, because it is a volatile industry. I mean, just in the past month, we've went down 20%, and that would be typical during a bull market. So you need to, unless you're going to be doing emotional things, which I'm sure you teach people is really bad, you need to really understand what you're investing in. It's one of the first rules of it. People out here that talk about trading, the difference in perspective really is people trying to make profit daily, weekly, whatever their strategy is, by trading in and out of wonderful products. That doesn't make any sense to me.
Yeah, the most people are looking at that we hear when they talk about trading. These day traders, sort of small market day traders, who they go in and they follow an algorithm and they say, okay, based on a 20-day trend or whatever it is, they're going to buy in and they're going to sell and they're going to buy in and sell. And there's all of this activity. It's actually, I don't know if it's really adding any economic value to the economy. Because really at the end of the day, it's the same thing. So what you're saying is if you have a really good thing, buy and hold it.
Yeah, I
And
mean, we may never see Bitcoin at 15,000 again, and that's when I bought it, right? I may never see 17,000 again. That's when I bought it. 20 years from now, if it's trading at a million and a half, I don't really care when you sold it on the way to that. You're an idiot. And I would argue that there are millions of people that probably bought it at 20, sold at 100, thought they were geniuses. And it's because they didn't understand the asset completely. And if they did, I doubt they would have sold it.
And
And
that's
I,
one thing that in our last conversation, you really hammered a big new point in my brain. And I sort of thought I understood, but this is the one thing that most people get wrong about crypto is they think about crypto as a currency. And we sat down and you said, well, right now, as we're doing this podcast, how many cryptos are we using right now? And
so,
I thought that was an interesting point.
yeah, there's close to 3 million tokens in circulation. Um, and those are tokens with $0 in market cap, meaning they were scams that got drained and they just still exist. Or, a $1 trillion token like Bitcoin. And I would say of those 3 million tokens, maybe 50 are competing to be a currency. If that. The rest of the market, 99.9% of the market, is using blockchain technology for a myriad of things, and trying to change a lot about how the internet works. So it's whenever I hear someone think of this industry as a currency market, similar to like Forex as an example, it's borderline offensive to the technology, really. But I understand mainstream media has led everyone to believe that it's a scam, it's for money launderers, criminals. They do whatever they can to try to keep it out of your hands.
So the idea of saying crypto as a currency is borderline offensive. It's because most people don't understand that crypto, only a very few of them are actually being used as a currency, but most of them are being used as a token for things like a protocol or something. And just shed some light on what that means, because I think that's a very important statement.
Yeah. First, I feel like I got to go back in time and explain the evolution of the internet, because I doubt it's something your listeners have really considered. The internet started with DARPANET back in 1963. That was the first computer. The government started without us knowing. I mean, if you were alive in that time period, there's no way you were aware of this. But in the 70s, it probably became more aware. IBM, Oracle came out, and they were basically working with the government, taking CIA, RFPs and building databases, creating relational databases, just building a bunch of stuff to the point where in 1989, the internet, which they had been building for 20 something years, became commercially available. That's what .com means. World Wide Web, commercially available, right? And that is the transition from Web 1 to Web 2. Web 1, it could only it could only read. So a computer talking to one another is only reading each other's messages. That's it. Soon as Web 2 came out, and that's 1989 to, 2009, you could read and write, meaning the users, like as soon as it came out, you could just write code and then put a website out. So Web 2 is the proliferation of putting information on the internet. Even today, what we're doing right now is putting this video, that's information, it's a file, putting it online, and then the other users can read it, open it, and watch it and view it. This is still Web 2 in 2024. We're still just exchanging information from the viewer listening or watching to a tweet, anything. It is just Web 2.
And that's
Web
where you
3,
talk about the back-end protocols. Is that correct? Where we talk about the HTTP, the SMTP, the IPOP, and
yeah, thank you for reminding me. Yes. So in Web 2, when the internet was commercially available, there were really smart people, computer scientists that are open source developers, and they take pride. To create a protocol that is enshrined in the internet for 50 years is like their Nobel Prize. They really pride themselves on that. Linux is the largest operating system, and I doubt most of your listeners know what that is. It's an open source protocol. If you Google the headquarters of Linux, you're going to find a picture of a laptop in a corner of someone's living room. Like, it is a massive organization supported by 20,000 developers that make $0, right? Because there's no way for them to trust one another and monetize that protocol. But when they make like SMTP, HTTP, DNS, IPOP, there's tons of these protocols that most of your listeners probably aren't even aware of. And they allowed really smart entrepreneurs to come around and build cool stuff like AOL Messenger. That was the first use case of SMTP that allowed us to send messages across the globe. So what you have to understand the environment. You have open source developers that build protocols, which are just instruction manuals to this World Wide Web that is owned by the government, right? And then you have the user that interacts with whatever is built. Then you have entrepreneurs that build stuff using the protocols. And it's really important to understand that, because when Bitcoin came out, a new kind of protocol, a new function, a new feature of the internet was unlocked. We can now exchange value, and that's a very difficult thing for people to understand, but we can exchange value through the internet just as easily as we exchange information. That is called Web 3. That is the evolution of the internet.
So can you
2009 to
define a little
present
bit
day.
more around the term value? I think taxonomy is really important. When you say exchange value, most people immediately obviously go to currency.
Sure.
But what do you mean by value that's outside of just talking about currency?
You could tokenize compute. So if I plug in my computer into the wall and it has a certain amount of compute, like I have a 2080 Ti, I know that's old, but it's an old gaming computer. That GPU can do things. It's a processor. You give it an input, it'll do an output, and it'll do it with 32 cores. Yeah, or I'm sorry, 10,000 something cores. That's a CPU. That's something different. But those cores have value in them because we need to process data, transactions, whatever else. You can use blockchain to associate a token with a unit of compute from someone plugging in their computer to the wall. Give them a token for just volunteering that GPU, and then when they sell that compute to a stranger, you get paid for every second that GPU is being rented by a complete anonymous person in the rest of the world. And it's all anonymous and encrypted, so you don't know who's using it. They can't access your device, but you can get paid for just plugging your computer into the wall. It could be a vote. A municipality, instead of doing paper ballots that are easily fraudulent, you could create a token that represents one vote per individual, and it would all be on a public ledger, anonymous, trusted. There's a lot of ways that you can exchange value using blockchain that was not once before possible.
So things like government processes such as voting or
Issuance of
a better
a license, any license.
Yeah, a license, the peer review process for medical, anything with data around medical to validate that you have an active insurance policy or any of these things. I think the tokenization can really provide a lot of insight to authenticating that this is actually true.
100%. And it really hits on a point. never once before have we been able to get on a website or do something and not care who we're interacting with and what's going on. It's you can trust the code in the environment that you're in to enforce both parties. If you're both consenting users, you don't need to know one another in blockchain. That's not true in Web 2. Everyone's user authenticated with their login credentials. You give all of your data and power to whatever like right now, Riverside has my information and your information. And whoever owns Riverside, if they don't like you or me, they could just get rid of the files. You don't own anything. You think you do. You might be sitting there thinking, well, I have 40,000 videos and photos in my phone. Those are mine. It's not your phone. It's not your servers storing those files. You own nothing. If Tim Cook didn't like the cut of your jib, you lose it all. And I would argue 10 years ago, no one really even thought about this, but you see the social layer changing. Cancel culture is a big deal. Big people getting ripped off of, mainstream media just so they can tweet freely. Tucker Carlson's a great example. Yep. Freedom of speech is worth hundreds of millions of dollars to Tucker Carlson. And it's only getting more prolific with Kanye West. And you can see the social layer really caring about digital property rights. And we've never had a protocol ever that would protect your digital property rights. And Ethereum brings us that.
I've always thought about Ethereum in that perspective when I first was looking at it, but I didn't have enough knowledge like what we're talking about today to really underpin an economic decision to invest in it or to investigate it a little bit more. Yeah. And so the idea of what we're talking about right now is, we chatted earlier about the idea that when you look at crypto, don't think of it as the gold. When you look at crypto, don't even think it as the shovel that dug up the gold. When you look at crypto, think about it as the steel that made the little hitches or made the shovel, because it's a building block for every single element that there follows.
Yeah, and it goes back to the example maybe 5 minutes ago. Like open source developers build the protocol. So if this is the internet, you have protocol, all over here, a web of protocols. Then you have an entrepreneur that looks at all the protocols and goes, I could use this for messaging. I could use this for storage. I could use this for user authentication, right? They pick and choose what protocols they can use because the protocols are the instructions the internet understands. A computer only knows what you tell it until AI, right? So you need the protocols to tell the internet what to do with your app. So the entrepreneur builds the app. The app is like Facebook. The protocol would be SMTP for Facebook Messenger, right? The URL is DNS that allows you to go to facebook.com. There's all these different protocols that Mark Zuckerberg used to build Facebook. And what you need to understand is those protocols, up until 2009, had no way of being monetized. There was no way for people to trust one another like that. So now in 2024, these protocols are supported by massive communities that have a lot of their wealth tied into them, a lot of incentives. And you now have nerds creating billion-dollar protocols out of thin air and actually being able to be compensated for that. 50 trillion plus has been built on top of SMTP. Those guys received $0. So
wow.
Not only
so what would be a protocol that is a monetized protocol that maybe we, with a little bit of knowledge we would recognize? Like obviously everybody knows HTTP. Most people who are slightly involved in website would know DNS. What are some of the other protocols that are highly monetized protocol?
None of them, brother. They're all just out there. Until Web 3, I would say Solana, Ethereum, Bitcoin, Avalanche, Cosmos. Like in terms of monetized protocols, there's thousands, if not hundreds of thousands in crypto.
Now, they're monetized on the base of when you look at Ethereum, and again, this is my ignorant understanding. When you look at Ethereum, it seems that the monetization comes from the buying or the creating of an Ethereum financial token. for somebody looking at the other way for it to make money on the basis of the protocol side, how would it make money in that environment?
Well, Ethereum, the protocol, gets paid every time a user touches it. So it would be like SMTP taking, I don't know, 1/10,000th of a penny for every message sent through it. Every time you publish a contract, anytime you buy or sell a contract, anytime you build an app and then you have users using that app, all of those fees trickle down to the Ethereum ecosystem. Not only that, Ethereum's deflationary. So every transaction creates revenue and also burns the supply of Ethereum. So it's going down in supply and it's increasingly more profitable from fees. It's a cash flowing asset. And you can stake your token and make more yield. Like I could buy 32 ETH, that's the minimum. And then I can put it into a staking protocol, which is basically just a bucket of code that holds my ETH. There's a bunch of terms with it. But then Ethereum uses my Ethereum, like my Ether. It'll use my tokens to support the network and whatever else. And then it has an obligation to give me back, right, 4 to 6% of Ether. So if I put up 32, next year I'll have like 35.5 Ether. Next year I'll have 41 Ether, and it just keeps going and going and going. So it's almost like a bond in a sense, an internet bond. But there
was some dark news around that where there was some things that were happening that are a little dubious, and I can't remember exactly around the staking process where people were staking, but it was not above board. Do you know what I'm talking about around that, or am I off course on that?
You're not jogging my memory.
Okay.
It would be amazing to me though, because if you do anything against the Ethereum protocol that's not in the protocol's interest, your stake could be 100% slashed. So it's heavily enforced. Like if you have 1,000 Ether stake, you have you have a small vote in the DAO, which is a whole other topic. But you control the protocol. It's an open source protocol, so everyone votes relative to how many tokens they have. So if you do anything against the Ethereum protocol, that ETH is gone. It's gone. If you're suspected, the code just does it. There's no one to call. It's the code. It just drains the wallet that your staked Ether's in.
Now, could there ever be a situation where that decision's made wrong?
Not that I'm aware of. I mean, it's computer code. You can't trick it, right? It's like if you, I'm personally not a staker, but the terms are very clear. And if you were to, you can vote any which way, but if really the biggest thing that a staker could do is approve a transaction that was, if they're elected, we're getting into consensus models, which are, I think, a little too deep for the audience, maybe. I don't know. But, if you're elected to approve or deny a transaction, and you approve a transaction that is faulty or anything else, and that this is automated, if it's within your decision protocol inside of the staking. Like if your computer's like, okay, this one we approve, and it's wrong, you lose your ETH, you lose a part of your ETH, you lose some of it. It's all pre-coded and it just happens instantly. So if you do something, you have to do it knowingly. And then if you do that, you're going to suffer. So it doesn't make, I would be shocked. I'll just put it that way. Now there could be someone that forked Ethereum, meaning literally copied and pasted it, because this is public. And then they built some kind of scam coin or meme coin, shit coin, I don't know. And then drained all of the stakers. Because, I mean, that happens frequently. You have to be very careful in this industry. But the layer one Ethereum sitting at 500 billion market cap, yeah, I doubt it. Personally.
And when you actually say that you actually own Ethereum, that goes down to the wallets. And I know there's also some layers on how wallets work. Whether you buy them through something like a Wealth Simple and what that looks like, or you buy them through some of the other platforms. as to whether you actually own the asset or you own rights to the asset.
Yeah, that all goes down to custody. So it's important to know that these tokens, they can't be replicated. Meaning, and a lot of people may not even pay attention to this, but our entire financial system is a credit system,
Mhm.
right? It's ones and zeros. That's why it takes time to settle. It's all credit. Doesn't matter. I don't care if you have your debit card and you're buying gas. Like, it's all credit, except for cash. Um, Ether is not credit. The IRS treats it as real property. It's an asset. It cannot be replenished. So, in that sense, it's direct one-to-one value exchange. If I send you one ether, it is one ether coming from my wallet. So you have to own it in that way. If you buy it through an exchange, you're basically putting your assets in someone else's care. Um, and if they fail, your crypto's gone, not your keys, not your crypto. And a wallet, for those out there, is basically like a password protected folder in your file explorer on your hard drive. You could think of it that way. Sounds a little bit more intimidating than it really is.
Yeah, it's one of those things where you see a big name brand and you think, okay, I'm going to use that because it feels like it's more protected because it's a big name brand. But you're saying that the idea of having that wallet localized to your computer, you're better protected because if the big one fails, you fail.
Yeah, and there really is a really hot debate. My hedge fund, I can't self-custody. They need a third party to be holding their assets and their funds, right? So that's a big deal. But personally, I kind of split. I argue with the idea that if I have everything in a cold wallet and something bad happens, my tokens might be more secure on a array of servers spread across the globe managed by a multi-billion dollar company. That way, whenever I get internet connection, I can just get my tokens. If a
Hmm.
tornado comes through, a fire, anything, and my cold storage device is lost or impaired or damaged, I'm screwed. So,
Yeah, that makes sense.
it really just depends on what you think the next 20, 30 years looks like. Yeah, I believe there's a significant probability of a international geopolitical conflict, perhaps even domestic here in America. And in that way, I feel like servers in 50 different countries would protect my crypto better than myself in a thumb drive. Um,
Yeah.
so I don't know. I mean, really, you just got to underwrite the holders. Like, I really like Bitstamp. They've been around since 2012, never been compromised. Coinbase, 2014, never been compromised. They have tens of billions of dollars of infrastructure. I believe, and they have a lot to lose. Um, BlackRock, all these ETFs, they all custody at Coinbase. So in a situation where Coinbase goes down, it's trillions of dollars go down.
Yeah.
And they have a lot of fail safes. They have a lot of things that like the consumer just can't afford. So
Yeah, you
it's
wouldn't be able to replicate that.
you just have to underwrite it and make a decision that you're comfortable with. Really, just like anything in
I
investing.
love the idea of when you use the fundamental terms such as underwrite when you're talking about crypto, because again, as you said, many people get in here, they're looking for that flash in the pan bump, in, out, that sort of thing. The other thing that you talked about when we had our preamble was we talked a lot about crypto markets. And we were talking about, and this I thought was really interesting because when you look at things like the TSX or whatever, or Wall Street, you have all these different industries. And you started talking about crypto in the form of industries. And I was like, what are you talking about? Are you talking about like Bitcoin or are you talking about this? And he said, no, like the crypto markets such as the gaming industry or the AI industry. And so I want you to kind of flush that out a little bit because I think that's extremely a unique way of looking at industry in the crypto space.
Yeah. I'm going to go back to the analogy that I referred to in that preamble, which was, if you had a bunch of money and you're trying to invest in the gold rush, a lot of people say the picks and shovels, right? But there's a few problems with picks and shovels. Let's say a million people migrate and try to, get some gold. You're only selling picks and shovels to the ones that make it, right? You're not buying picks and shovels halfway through Indian territory. You're buying it in California. There are a lot of second order consequences to the gold rush, like all of the brass needed to make the wheels that go on carts, all the canvas to make the roofs of the carts, food wholesalers, because people are buying in months or quarters instead of days. That's a new industry that just pops up, right? You start really thinking about it, there are a myriad, 50, 100 different second order consequences that all stand to benefit from the entire population's ambition. Because for every one successful person, there's 1,000 that got slaughtered or died on their way there. And I look at crypto the exact same way. I'm that detailed and meticulous. So when I look at the market, I look at industries from a perspective of all the different ways we are building Web3. If you can look back at Web2 and understand how it was built out and what was the most prolific, most impactful protocols, and you look at similar use cases in Web3, changing the word information to value, and then you start looking for the solutions and the things that are assisting in the further transmission of value online, which is really the precipice of my thesis. So when I look at crypto, I'm looking for specific sectors that are solving specific problems of digital assets. A quick example would be bloat, blockchain bloat. It comes from this promise, right? That no matter what happens, no matter, my computer's dead for 10 years, I turn it on, I can go find my crypto. I can go look at every transaction of everything I've ever done, right? Well, that's data that needs stored. As the blockchains exist for longer periods of time, they need more data to show you. That's called data availability. And eventually they'll get too congested to be used. This is a problem that a lot of computer scientists and researchers are aware of. So I look for blockchain scaling as an industry, and I invest in the solutions that are most probable to solve that problem. Because if blockchain's here to stay, that problem must be solved. It is a guarantee that we need to solve that problem. Then it's just about breaking down through my screening process what is the most probable asset to do that. And you can basically approach any problem through that perspective in crypto. Like AI, we all know the powers of AI and language models and quick compute, but there are second order consequences to AI. If I was looking at stocks and equities, I'm thinking copper, nickel, lithium. Those are all the raw material to build the CPUs and GPUs that'll power AI. I'm thinking of all the different apps that could be dramatically improved, like Google's indexing feature. Just the raw tech of the indexing Google can do is one of my biggest plays in AI. There's just again, a lot of people think these are currencies, but these are internet protocols. Where there are millions.
So what would be the internet protocol that's being used to do the raw testing stuff with Google? What's the underpinning?
Yeah, the indexing is fetch.ai. It is a language model enabled indexing protocol. So if I wanted to have the power of Google's algorithm, if not better, using AI, I can just buy some FET, use their SDK, and then put it into my app, if that would ever be enticing to anyone. So it's democratizing the value of Google's indexing algorithm, if not better, because it's from the ground up written with AI. It's not
say
exactly
that one more
Google.
time. Say that one more time in a way that the person who's not a programmer would understand what you meant around that. Because I think that right there is the nub of what you really propose around using the fetch and how somebody would integrate that into their program.
So indexing is basically a way to how about this? You have a table filled with a bunch of grapes. There's like hundreds of grapes on the table. And someone's like, I want the grape with two black spots, a short stem, and half the skin missing. But there's like 10,000 grapes. And a computer, basically what a computer does, it's process oriented. So it's just going to pick up each grape, inspect, put it down. And the more processors, the faster it can move through those grapes, right? Okay. Indexing would be like, these are all the red ones, these are all the green ones, these are all the blue ones, these are all the things, these are the ones with the half stems, the full stems, these are the ones with skin, without skin, and then quickly show you the one you're looking for, because it is indexing them. And Google has found a way to do that with hundreds of billions of URLs. It's very powerful. That one page, when you type in JT knows things, and there's 8,000 pages of results, but the first one is the one you were looking for. That's indexing. The engine that allows Google to do that is on sale for, I think, 8 cents a token. Now, what do you think the total obtainable market cap of that indexing is? And then look at the market cap of Fetch, and you can see 2% of your portfolio could turn into 20% in 10 years. Like, if Fetch is the one to do it.
And how did they, obviously every industry is going to be vying for, dominance, whoever the protocol developer is. What is when you look at that and somebody's building that tokenized protocol, how much competition is being around those specific tasks? Is it highly coveted space to be Fetch, or is Fetch just sort of, now it's there, it's sort of given its space and somebody's building somewhere else?
This is the cool part. The nuance of indexing is so niche, so specific, that other people are making AI model stuff to do slightly different things. Although there are people that are competing with Fetch, my screen really is like, needs to be 500 million market cap or above starting. That wipes out 80% of the market. And then if you go to AI as a segment, you look at all the tokens that are above 500 million, there's only 6. Then if you go, they've been around 3 years, it's only 3. Then from 3, got to have Doc's team. I have 21 points I go through. Fetch is the only one. The other ones might be able to compete in a year or two, but they have a multi-year head start. So I'm, again, underwriting these assets with risk in mind. I look at it as a game of probabilities. What is the most likely to succeed? Well, there's a lot of computer science laws that a lot of people don't understand or think about in this investment process. There's Metcalfe's law. There's Lindy's law. Lindy's law states that if it's an intangible product or idea, concept, whatever, intangible, its probability that it will persist through time is only increased with the amount of time that it exists presently. So if something's been around for 2 years, it is twice as likely as something that's brand new to stick around. Look at the idea of capitalism, the idea of liberty, the idea of freedom. These are intangible things. Lindy's law is a very powerful thing. Metcalfe's law states that the value of a network is the amount of nodes squared. And it's I could do a simple explanation. You have person A, person B, person C. That's 3 nodes, right? But you could go from A to B, B to A, B to C, C to B, C to A to C, right? That's 9 total interactions between the nodes, so 3 squared. And, if you look at the networks that have the most nodes, most liquidity, been around the longest time, you have the highest probability of succeeding. And it's really that equation that allows you to make really good picks.
That sounds so much more intoxicating to look into the crypto market, in the sense that, number one, it's on vogue, that there is a certain amount of fashionable element around it. But to then review it through a fundamental approach of saying, you're using your Lindy's Yellow, using your Metcalfe's Law, and looking at, what is the market cap of that tokenized protocol, and seeing how much could it grow over the next little bit, and comparing that, to other segments that are in there. That's a whole different way of evaluating that. And that's probably why when you were setting up your fund, you probably got a lot of legs behind it, because you weren't just hey, we're going to trade a bunch of Bitcoin.
Right. And my returns, I'm getting anywhere from 20 to 80% a quarter. The last attested or audited returns were 74.71% in Q4 of 23. We get them annually, the audits, because we're a discretionarily long fund. I feel like quarterly's an unnecessary expense because it costs $7 to $12 to get audited. But once a year, so the last 23, we really crushed it. The last NAV I did, we were up 38% from Q1 of 24. We're probably down 5 or 6% right now for Q2, but the market's been getting hammered. So,
for your fund, are you able to talk about how much has been committed in assets to your fund?
Yeah, I just gotta be careful about clients, but we have 16 million committed to the fund by end of year with 2 RIA partners. We accept retail, so that would be an accredited investor or qualified investor. That's a net worth of $1 million or a gross income for an individual of 200,000 or a family of 300,000 each year approved through tax records. And then we also partner with RIAs or registered investment advisors. To your listeners, that would be someone that possibly manages your 401k, your IRA, or any of your other investments. We really enjoy the RIA partner side because it's the same exact presentation. It's the same ask. 5% of your portfolio could outpace the other 95% in long enough time horizons. Same ask, but the 5% to an RIA is a lot different than retail.
Oh, for sure it is. And the numbers are staggering. Yeah.
I mean, a small
we could talk so much about the idea of what it took to build, because when we chatted about that, what it took to build the hedge fund and all the, quotation figures, fun that it took to go through all of that. That's a whole nother conversation. I'd love to have you back and chat about that and talk about what it takes to build a fund. And it's simple word is just a lot.
Yeah.
So
there's a reason why
it's been, man.
Oh, sorry.
We can talk about that one for sure. What I want to do is I want to make sure we do have you back to talk about building a hedge fund or building a fund rather. And I think that's really important. And man, I really thank you for opening my eyes on the crypto market and really taking a completely different lens around how to understand crypto. I wish I would have known this a bunch of years ago, that crypto isn't just the thing that we see with Bitcoin and all of this stuff. It's not a GameStop kind of an event. It's an underpinning society event in the way that it factors into all the protocols we use on a daily basis.
100%. I'm glad I could be of service to you and your audience,
Thank you so much. And man, so for people to get a hold of you, the easiest way for them to do is to go to your bleedingedgecapital.com and find you there. He's also got really good activity on his Instagram and on his LinkedIn. JT Knows Things is a great way to find him, and or Jake T. Tullis on Instagram. And thank you very much for joining us, my friend. I really appreciate it.
Right back at you, man. Had a lot of fun. Excited for the next one.
Absolutely. And guys, this is the Money, the Mindset, and the Mentoring podcast. We will see you on the next one.